Something unusual is happening in the global financial system right now, and the deeper you look, the less it makes sense. Oil prices have surged close to $120 per barrel, not gradually, not over months, but in a sharp, aggressive move driven by one of the largest supply disruptions in modern history. The ongoing conflict in the Middle East has effectively choked flows through the Strait of Hormuz, a narrow route responsible for nearly 20% of global oil supply. This is not just another geopolitical headline. This is a structural shock. At the same time, energy infrastructure across the region is being directly targeted. Oil facilities, refineries, and logistics hubs have been hit by drone and missile strikes, further tightening supply and increasing uncertainty across global markets. And the result is already visible. Now here's where things get even more important. As of April 5th, 2026, the data coming out of global markets over the past few days is starting to confirm that this is not just short-term volatility. It may be the early stage of a much larger shift. And what happens next may change everything. Oil has not just risen, it has exploded. Prices have surged more than 50% in a short period, marking one of the fastest increases in recent years, with some analysts warning that if disruptions continue, oil could move toward $150 or even higher levels. Now, under normal conditions, this would trigger a very clear reaction across financial markets. Energy prices rise, inflation follows, central banks tighten, and equities decline. Not temporarily, but consistently. That's the pattern the system has followed for decades. But this time, something is different. Because despite all of this, despite rising oil, rising inflation risk, and rising geopolitical tension, markets are not collapsing the way they normally do. They are falling, but stabilizing. They are reacting, but not breaking. They are volatile, but not panicking. And that is where the anomaly begins. Because when markets stop behaving according to historical patterns, it usually means one thing. The visible movement is not the real story. Now take a step deeper into what's happening behind the scenes. Inside energy markets, traders themselves are struggling to interpret price movements. In many cases, oil is no longer being driven purely by supply and demand. It is being driven by fear, headlines, and geopolitical signals. That is a major shift. Because when markets move away from fundamentals, they become unstable, they become unpredictable, and more importantly, they become driven by expectations, not reality. Now here's where things become even more important. This is not just an oil story, this is a system story. Because oil sits at the center of the global economy. It influences transportation, manufacturing, logistics, agriculture, and even financial markets through inflation and interest rates. So when oil moves like this, everything moves. And we are already starting to see that ripple effect. Across global economies, fuel costs are rising, supply chains are tightening, and businesses are beginning to feel the pressure. Airlines are adjusting pricing. Logistics companies are increasing costs. Even basic goods are becoming more expensive as input costs rise. This is how an energy shock spreads. Slowly at first, then all at once. But here's the key question. If the shock is this large, why aren't markets reacting more aggressively? Why isn't there a full-scale sell-off? Why isn't capital leaving risk assets completely? The answer lies in something most people don't see. Markets are not reacting to the present. They are reacting to the future. And right now, that future is uncertain. Because when institutions look at this situation, they don't see just one outcome. They see multiple possible scenarios unfolding at the same time. One where tensions ease quickly, one where disruption continues, and one where the system itself begins to shift. So instead of reacting in one direction, markets are splitting. Part of the market is pricing in risk. Another part is pricing in recovery. And that creates exactly what we are seeing right now. Volatility without collapse. Now think about this carefully. In previous crises, markets moved in one direction because the outcome was clearer. During the 2008 financial crisis, The issue was systemic. Liquidity collapsed and markets followed. During the COVID crash, the shock was sudden and global. Markets reacted immediately. But today, the situation is more complex because this is not a demand shock. It is a supply shock. And supply shocks behave differently. They don't always create immediate crashes. They create pressure, slow spreading structural pressure. Now let's go one layer deeper. This oil shock is not happening in isolation. It is happening at a time when the global economy is already in a fragile position. Inflation has not fully stabilized. Interest rates remain elevated. Debt levels are historically high, and liquidity, the single most important driver of markets, is already tightening. That combination matters, because when a system is already under pressure, it takes less force to destabilize it, and that is exactly what makes this situation different. At the same time, global supply chains are once again under strain. The Strait of Hormuz is not just an oil route, it is a critical choke point for global trade. When that route is disrupted, it affects not just energy, but chemicals, fertilizers, and even food supply chains. And those disruptions don't show up immediately in markets. They show up slowly, through rising costs, through delayed shipments, through tightening margins. Now combine all of this together. Rising oil, supply disruptions, inflation pressure, tightening liquidity, and yet markets are not collapsing. That is the anomaly, and anomalies in financial systems are never random. They are signals that something beneath the surface is changing. Because when institutions, the largest players in the market, see this kind of environment, they don't panic. They prepare. They reposition. They adjust exposure quietly. And that is exactly what appears to be happening right now. Instead of exiting the market completely, capital is rotating, moving from one sector to another, from risk to relative safety, from growth to stability. This is not fear-driven behavior. This is calculated behavior. And historically, when institutions begin to reposition quietly during periods of stress, it is not because of what is happening now. It is because of what they expect to happen next. Now here's something most people miss. The biggest market moves don't happen when the news becomes obvious. They happen before. They happen during the transition phase, the phase where everything looks confusing, where signals conflict, where nothing seems to fully make sense. That is where we are right now. So the real question is not whether markets will go up or down tomorrow. The real question is, what are institutions preparing for behind the scenes? Because if this is not a normal correction, if this is not a typical oil shock, if this is not a standard market reaction, then it may be something much bigger. And before we go deeper into that system, if you're watching this and you follow markets, macro trends, or global shifts like this, take a moment to subscribe, because these kinds of transitions don't happen often, but when they do, they define entire market cycles. And also, drop a comment below. What do you think is really driving this market right now? Is it oil? Is it war? Or is it something deeper? Because sometimes the smartest insight comes from asking the right question. And the next part of the story is where things start to connect. To understand what's really happening right now, you have to stop looking at the market as individual events and start looking at it as a system. Because what we're seeing is not just an oil shock, it's a chain reaction. Let's start with the first layer of that system, liquidity. This is the most important concept in financial markets, and also the most misunderstood. Liquidity is what allows money to move freely through the system. It determines how easily assets can be bought, sold, and priced. When liquidity is high, markets feel stable. When liquidity starts to tighten, everything becomes more sensitive. And right now, liquidity is quietly tightening across the system. This is happening because of one key factor: rising yields. As oil prices surge and inflation expectations increase, bond markets begin to adjust. Investors demand higher yields to compensate for future inflation risk. We are already seeing this in the data. U.S. Treasury yields have risen significantly in recent weeks, with longer-term yields moving faster than short-term ones, a signal that markets expect inflation to remain elevated for longer. And when yields rise, the cost of money rises. That impacts everything. Corporate borrowing becomes more expensive. Mortgage rates increase, already climbing above 6.4% recently. Consumer credit tightens. And most importantly, risk-taking slows down. This is how liquidity leaves the system. Not all at once, but gradually. Now here's where it gets interesting. Even though liquidity is tightening, it hasn't disappeared. That's why markets are not collapsing. Instead, what we're seeing is something more complex, a transition. Because liquidity doesn't just leave the system, it moves. And that brings us to the second layer, institutional behavior. Large institutions, hedge funds, pension funds, sovereign wealth funds, do not react like retail investors. They don't panic. They reposition. Right now, that repositioning is already happening. Energy sectors are gaining strength because they benefit directly from rising oil prices. At the same time, rate-sensitive sectors, especially technology and growth stocks, are facing pressure due to rising discount rates. This is not random movement. This is capital rotation. And it tells us something critical. Institutions are not exiting the market. They are preparing for a different environment. Because if they believe this was a full collapse scenario, they would be reducing exposure across the board. But they're not. Instead, they are shifting positions quietly. Now let's move to the third layer. Inflation. Inflation is where everything begins to connect. Because oil is not just a commodity, it is a cost input into almost every part of the economy. When oil prices surge like this, it doesn't stay in energy markets, it spreads. Transportation becomes more expensive, shipping costs increase, manufacturing margins shrink, and eventually, consumers feel it. This is exactly what we're starting to see globally. Fuel costs are rising, airlines are adjusting pricing, logistics companies are increasing rates. Even basic goods are becoming more expensive as energy costs move through the system. Now here's the key problem. This type of inflation is different. It is not demand-driven. It is supply-driven. And that changes how central banks respond. Institutions like the Federal Reserve, the European Central Bank, and even the Bank of Japan are designed to manage demand. They raise interest rates to slow spending. They lower rates to stimulate growth. But they cannot fix a supply shock. They cannot reopen the Strait of Hormuz. They cannot increase oil production overnight. They cannot stabilize geopolitical conflict. And that creates a constraint, a situation where central banks are forced to keep financial conditions tight, even if the economy begins to weaken. This is one of the most dangerous environments in macroeconomics, because it limits policy flexibility. We are already seeing warnings from central bank officials about this risk. Some analysts are even suggesting that policymakers may be underestimating the economic impact of supply disruptions, especially on production, trade, and manufacturing. And when central banks miscalculate, markets react. Now let's move to the fourth layer, the global ripple effect. This is where things start to expand beyond financial markets. The Strait of Hormuz is not just an oil route, it is a global economic artery. When it gets disrupted, the impact spreads far beyond energy. Chemical supply chains are affected. Fertilizer production is disrupted. Food supply chains begin to tighten. In fact, nearly 20% of global LNG and a significant portion of fertilizer inputs pass through this route. So when shipments stop, the consequences don't show up immediately in stock prices. They show up slowly, in rising costs, in delayed production, in tightening supply, and eventually, in economic growth itself. Now combine all of these layers together: liquidity tightening, institutional repositioning, inflation spreading, supply chains breaking, and yet, markets are still not collapsing. That is the key signal. because when a system absorbs this much stress without breaking, it usually means one thing. The adjustment is not happening yet. It is building. And that brings us to the most important insight in this entire situation. Markets are not reacting to what is happening today. They're reacting to what might happen next. Right now, institutions are not making one bet. They are preparing for multiple outcomes at the same time. One scenario where tensions ease, one where inflation remains high, and one where the system itself shifts into a new phase. This is why markets feel unstable, but not broken, because they are caught between possibilities. And historically, this kind of environment appears right before major transitions, not always crashes, but shifts. Shifts in how markets behave, shifts in leadership, shifts in risk. And that is exactly what makes this moment so important, because what we are seeing right now is not the result of the shock. It is the system adjusting to it. And the next phase of that adjustment is where things begin to move. Before we move into that final phase, take a second and think about this. Do you believe this is just a temporary disruption? Or do you think this is the beginning of something bigger? Drop your answer in the comments. Because the next part of this story is where everything connects. Now everything starts to connect. Because when you step back and look at the full picture, this is not just about oil. This is not just about war. This is not even just about markets. This is about a system under pressure, trying to adjust without breaking. Right now, global markets are sitting in what can only be described as a transition phase. Not a collapse, not a recovery, but something in between. And historically, this is the most important phase of any cycle, because this is where the next direction is decided. Let's break this down clearly. At this moment, three major forces are moving together at the same time. Oil prices are rising sharply, inflation pressures are building again, and financial conditions are tightening. Individually, each of these creates stress. But together, they create something much bigger. They create systemic pressure. This is the kind of environment that institutions like the International Monetary Fund and central banks continuously warn about, because when supply shocks combine with tight monetary conditions, the system becomes unstable, not immediately, but structurally. And that's exactly what we're seeing right now. Markets are not reacting in a straight line anymore. They are reacting in waves. One day, fear dominates. The next day, optimism returns. Then uncertainty takes over again. This is not randomness. This is a system trying to price in multiple futures at once. Now here's where things become critical. Because when markets enter this kind of phase, they are no longer reacting to current data. They are reacting to potential outcomes. And right now, there are three major scenarios being priced into the system. Scenario 1, the relief rally. This is the outcome that many investors are quietly hoping for. If geopolitical tensions begin to ease, if supply routes reopen, if oil prices stabilize, then inflation pressures could start to come down. And if that happens, central banks like the Federal Reserve could regain flexibility. They may not cut rates immediately, but they could slow down tightening. That alone could be enough to bring liquidity back into the system. And when liquidity returns, markets rise. This is why you're still seeing moments of strength in the market, because part of Wall Street is already positioning for this outcome. But here's the problem. This scenario depends on something very uncertain, geopolitical stability. And right now, that stability is not guaranteed. Scenario 2, prolonged pressure. This is the scenario that markets are trying to avoid, but cannot ignore. If oil prices remain elevated or continue rising, then inflation could stay higher for longer. And if inflation stays high, central banks will have no choice. They will keep financial conditions tight, interest rates will remain elevated, liquidity will continue to tighten, and economic growth will begin to slow. This is how slowdowns begin. Not suddenly, but gradually. Businesses start cutting costs. Consumers reduce spending. Investment slows. and markets begin to reflect the pressure over time. This is not a crash scenario. This is something more difficult, a slow grind. And historically, these environments can last much longer than expected. Scenario 3, the volatility shift. This is the scenario that very few people talk about, but it may already be starting, a structural shift in how markets behave. In this environment, markets don't move in clear trends anymore. They move in sharp, unpredictable swings, up quickly, down quickly, without clear direction. This happens when uncertainty becomes the dominant force in the system. And right now, uncertainty is everywhere. Oil supply is uncertain. Inflation is uncertain. Central bank policy is uncertain. And when everything is uncertain, markets stop trending. They start reacting. This is often the most difficult phase for investors because traditional strategies stop working. And this is where institutional positioning becomes even more important. Because institutions are not trying to predict one outcome. They are preparing for all of them. They are diversifying exposure. They are managing risk more actively. They are staying flexible. And that's exactly why markets are behaving the way they are. Not collapsing, but not stable either. Now, take a step even further back. This is not just about this moment. This connects to a much bigger cycle. Global debt levels are at historic highs. Interest rates have already moved higher after years of easy money. And now, a supply shock has entered the system. This combination matters because historically, when debt, inflation, and supply shocks collide, the system adjusts, not always through a crash, but through change. Change in market leadership, change in capital flows, change in economic priorities. And that is what Wall Street appears to be preparing for, not just reacting to the current situation, but adjusting to a new environment. Because if this is not a temporary disruption, if this is not just another cycle, then it may be something deeper, a shift. And shifts in financial systems don't happen often, but when they do, they redefine everything. Now think about where we started. Something unusual is happening. Markets are not behaving the way they normally do. Signals are conflicting, movements are inconsistent, and that confusion is not weakness, it is transition. Because before every major move, there is a phase where nothing makes sense. That is where we are right now. So the real question is not what is happening today. The real question is what is coming next. And if you've stayed with this until the end, you already understand something most people don't. This is not just noise. This is not just news. This is a signal. So if you want to stay ahead of these shifts, make sure to subscribe. Because these moments don't happen often. But when they do, they define the next phase of the market. And share this video with someone who follows the economy. Because right now, understanding what's happening may be more valuable than ever. And if you had to choose one scenario, which one do you think plays out? Relief rally, prolonged pressure, or volatility shift? Let me know in the comments, because what happens next may change everything.